Partner and head of a £100 million impact fund at Palatine Private Equity. Palatine is a UK mid-market private equity house who raised their first impact fund in 2017. We've got Michel, who is Group Director of Impact Investment at Sky Ocean Ventures within the Sky Group. Fred has been leading the company strategy on impact investing and is now deploying an internal £25 million pool of capital into innovative companies tackling ocean plastic and waste. We then have Marjoleine van der Peet, who's a senior portfolio manager at Kempen and co-portfolio manager of their global impact pool, which invests in impact funds and products. And last but not least, we have Duffy, who is head of corporate governance in the responsible investment team at AXA Investment Management, and has been instrumental in developing and deploying their two impact fund of funds. So we've titled this panel discussion, Impact Investing, Why Take the Plunge? Predominantly because I think all of our panelists have approached impact from quite different starting points, but have all recognized in their own way that there is space for a variety of different investors in this space to really become market leaders and to drive the agenda forward. The objective of the panel is to really unearth what the motivations for everyone was into getting involved in impact, the challenges they have faced and probably still do face, and really what they're trying to achieve in the long run through their investment strategies. I'm going to leave 20 minutes at the end of this 60-minute session for questions from the audience. But I want to just kick off by asking each of them to introduce themselves and their journey to impact just in a little bit more detail, a few minutes each. And Beth?
Yeah.
Well volunteered.
Yeah, so I'm a partner in Palatine Private Equity. We are a traditional private equity house headquartered in Manchester. I've been there for 11 years now, so worked across the three funds that we've raised to date. Our last fund was a 220 million fund, which we are partway through investing. And I think over the years, our route to impact investing, over the years we've been very involved in ESG, probably been looking at ESG and how we do that across our traditional funds for the last 8-9 years now. And probably seen as one of the leaders within the lower mid-market in terms of how we look at ESG and how we implement it. And as a result of that, we've won, I think it's 7 or 8 awards now for our ESG initiatives. We really believe that ESG creates value in our organisation. So when we started off, it was probably as a result of some of our LPs asking us about our ESG strategy. But over the years, we've seen the real benefit that ESG can bring to all of our investment companies. And so now it's fully ingrained into Palatine, into our methodology and our value creation plans as well. And we've had lots of our portfolio companies get a lot of value from the ESG initiatives that they've implemented over the years. As a result of that, about 2 years ago, we were looking to raise a different type of fund, and we had a number of options. Did we raise a minority fund, a small deals fund, lots of different routes we could have gone down, but since we all believed in ESG and really felt that it was the way forward, we decided to go out and raise an impact fund and take that ESG initiatives one step further. So we launched that probably about 2 years ago now. Spoke to our existing LPs in terms of whether it was something that they would be interested in, and successfully raised our first 100 million impact fund in September 2017. We have been investing in that for the last year or so, and we've got 3 investments in that fund to date. And we are in the process of sort of rolling out. It's very much a returns-focused impact fund, so we went to market to say, look, we've got these 3 traditional funds, and we're used to generating private equity returns from these funds. We've got this great ESG background, and we're going to merge the two and create a returns-focused impact fund.
Great. Thanks very much, Beth. And Fred? Why not?
Right, let's go. Thanks for having me. I'm pleased to be here because ClearlySo has been helping us in important stages of setting this up last year. So a bit of context, Sky, you probably know TV Group, we're in 7 markets across Europe. We've got 23 million customers, 33,000 employees. We've got a big track record in terms of sustainable issues, first company in the media world to be carbon neutral. We have a CEO who has been extremely influential internally in driving the company on the sustainability agenda. I've been involved at inception with him, sort of setting up our new campaign, which was 2 years ago, when we decided to apply our voice, let's say, in our platform, the fact that we have an ability to reach consumers directly, to try to affect real change through an issue we thought, even before Blue Planet, was going to be important. And so we decided to dedicate a lot of our efforts, especially first on content, sort of describing the disaster of plastic, trying to raise awareness across sort of consumer groups. And then when we thought the climate was such that people were more aware of the importance of that issue, we decided to take more stronger corporate commitments. So we decided to transform the business single-use plastic-free by 2020. We'll be the first one in the FTSE to do that. And we already have a guide which is available to anyone who wants to do it as a corporation. We've also taken the step of investing. We decided in solutions. So we didn't just want to raise awareness, we also wanted to apply that voice to trying to help and make an impact. So that's why we decided that very unusual step for a media company to have its own impact investment fund, 25 million directly from us. We've been at it for 8 months, and we've made so far 6 investments. We do them every month directly with our CEO, who sits on the IC, and me and 2 other execs. And we look for early stage, sort of pre-seed, seed, Series A innovators who can answer some very specific plastic areas, which I can develop. I'm very pleased to be here because for us, impact is a very new area. And we think that hopefully we can play a role in trying to sort of showcase the value of impact investment.
Thanks very much, Marjoleine. Over to you.
Yep, thank you. And thank you, Harry and Rod, ClearlySo, for inviting me on this panel. It's an honor to be here today and to introduce myself. So I'm Marjoleine van der Peet. I'm from the Netherlands and I work for a Dutch firm called Kempen Asset Management. It's an asset manager in the Netherlands working for mostly pension funds and some family offices, foundations. And we always had ESG at the forefront of our investment beliefs. And we have now started to deploy capital in impact world as well for our clients. And we launched an impact product, the global investment pool, for our clients to really lower the barrier for them to start investing, because we found that there were lots of barriers they were running into, but maybe we can talk about that later. I'm the co-portfolio manager of that pool, and I have an investment background, and my other co-portfolio manager, she has her background is in the impact space. And together so we built an impact portfolio and a measurement framework. Maybe we can also talk about that a bit later. And we've launched this in January 2018, and we've been running it now for a year. And we have 70 million in that pool and 5 fund investments. And it's a good structure with lowering the barrier with a quarterly liquidity, so we keep getting money in, so we keep deploying more capital, so our impact just grows and grows.
Great, thanks very much. And Sade, to you.
Okay, good afternoon. I'm here representing AXA Investment Managers. We, like Kempen, are a mainstream asset manager, over 700 billion AUM, invested in a range of asset classes that you traditionally associate with an organization such as ours. We started our journey into impact in 2012. One of the things we have is a very strong responsible investment mantra, where we take account of ESG issues in the way that we invest in for our clients. So in 2012, we started to think about evolution of this RI strategy, in the sense that we help our clients avoid investments that harm society. It's a key part of what we do. We work with investee companies to influence them to do better, take account of ESG issues. But when we looked across the range of the things we did, we realized we could go further. We could go beyond just avoiding harm. We could go beyond integrating ESG issues into how we invest to actually being part of the solution. And that was when we started to think about impact investing. We launched our first fund in 2013, working with our parent company, AXA Group, which is a financial protection and insurance company. And we devised a fund that really aligned with the core activities of AXA Group and AXA IM. If we're starting to think about investing in solutions, what is the way to deploy that kind of capital? And our first impact fund in 2013, we launched a fund of about 200 million, focusing on key challenges in terms of financial inclusion, access to health, and education. That worked. It worked so well that in 2016, we launched a second fund. This time going beyond just social aspects and social challenges to start to think of environmental issues, because for our clients who were principally initially thinking about things in the social space, what they started to recognize as a key challenge to their business was climate change. So we thought we could also use our impact investing view to really invest in innovative solutions tackling both social and environmental challenges. And that's where we are. So now we have 380 million so far. We've invested, using a fund-of-fund approach, we've provided capital to 24 funds, but more importantly, we've catalyzed innovation in over 300 businesses.
Great, thanks very much everyone for the introductions. I will open the floor to questions later, but I obviously have a few things I want to really ask the panel myself. My first question is, why now? I mean, we certainly at ClearlySo have been talking about impact for over a decade, and as Rod will admit, we were a little bit early. But it seems as if there is really this step change, the types of organizations who now want to set up vehicles or invest in vehicles such as yours. So I think I want to, I guess, ask you guys openly is, what are the key drivers that you have actually seen? Is it from investors? Is it the companies that you're looking to back? I mean, what have you seen that's really changed in the last sort of 2 or 3 years now? Maybe Marjoleine, I'll start with you, given you launched your fund in January.
Yeah, sure. And I really liked what Chris was saying earlier during his speech, and he said that investors might not have the same terminology as we have in the impact space, but they care. They care whether their money helps create more jobs, and they care whether their money helps improve the environment. And I think that's it. It's about raising awareness, what Sade also already said. It's as soon as they get awareness, they want to do something about it. And I think because we came from the ESG journey, and so that's where we started. And I think if you just start talking about being able to become part of the solution rather than avoiding a problem, maybe I think that is for us was the main driver for that change. And I think that started with us with launching our pool last year, but I think that's only the start of it.
And Fred, I mean, from a Sky perspective, I guess that the question is, why impact investing, and why ocean plastics in particular? I mean, it's specific, but obviously it's fundamental to your company now.
Yeah, so as I was referring a bit earlier, I think for us it's definitely trying to demonstrate that we can leverage the power of a media company. So it's basically media-powered impact investment in a way, and sort of give visibility to innovations that that can really help deliver some solutions. But I think there's also, and Chris mentioned it, is the consumer behavior. And I think the sustainability sort of thread is now so important across the piece that if we can, I think through doing impact, substantially demonstrate that this is an area which no one can avoid now as a corporation. And for us, it's very much, saying that we can, for example, help innovations we back, even if they're, we're doing very early stage, very high risk, 1 billion idea, that's where we want to be, because that's where we can give most impact to those innovations. But if we can give them visibility, then they can hopefully be sort of being adopted and scale up really quickly. And that's where I think we went there, because we can help scale up innovations very quickly. And if we don't do it, no one's going to do it. So it's a bit of a recognition that you can walk the talk, but also you can lead by example, but more also importantly, you have to probably step in where governments and traditional businesses maybe can't go into, which is very much try to source and give a chance to those innovations that can have an impact. And then hopefully through going there, rally a sort of ecosystem around what we're doing and create a sort of culture of impact. And that ecosystem that we're creating, and I can talk about it if you want later, that ecosystem would hopefully generate even more players to come into that space.
Yeah, absolutely. And Beth, I think obviously you've gone through, as some of the fund managers pitching later, the painful process of trying to raise money from LP investors, obviously, in raising your fund. I mean, when you're speaking with them about impact, I mean, what were those main challenges for you, and why would you put yourself through that?
Yeah, it's a good question. I think when we went to raise our impact fund, I think LPs were just starting to think about impact and what they were going to do about it. And I don't think any of the money from the LPs that we received was from a specific impact pot. So it was certainly from sort of their lower mid-market equity allocation. So obviously proving and convincing them of the returns part of our fund was key to getting that investment from those LPs. But I do think that LPs are now starting to think a lot more about impact, and also starting to think about, do they need an impact pot that they can allocate to funds as well. I think we were probably just a little bit early before that, but certainly I'm having conversations with LPs now where they're definitely coming to think about that. And then I think, why now? I think you've got LPs thinking about it more. I think you've got more mainstream GPs coming into the market as well. So you've got that nice returns and purpose element coming into the market. And also you've got funds, you've got companies that we can invest in. So there's a lot more smaller impact companies and impact entrepreneurs out there that are starting companies that are really impactful, that need private equity investment as well. So I think you've got almost three things coming together at once, and that's why you've seen quite a big rapid increase in the impact space.
Yeah, I mean, just to follow on from that point, I mean...
Can I just ask so I can follow the conversation?
Yeah, sure.
What's an LP and what's a G?
Sorry.
Sorry.
Beth, you go for that one. Sorry about that.
Yeah, so we would be a GP, so Palatine would be a GP, and we invest the money, and LPs are our investors, and there's a limited partnership, so those are all the pension funds. So our typical investors would be pension funds, insurance companies, and people like that.
Yeah.
Sorry.
I should have clarified. Sorry. So just yeah, I should have. So just to follow on from that, I mean, you spoke there about the larger, more high-profile and high-caliber fund managers coming into this space. So we mentioned sort of TPG Rise with their $2 billion impact fund. I mean, there's been, I guess, a lot of questions around how impactful that is, given the ticket size that they're looking at, and I guess how they interact with the other funds, which typically are smaller in scale, and how they're competing for LP funds from other investors. So I mean, I don't know, Sade, given obviously another major player in the market, that how you see that interaction happening with people like TPG.
So when we started this journey in 2012, as large investors, one of our concerns was the availability and quality of funds out there. So I am one to welcome all kinds of different players in this space, including the big funds like TPG. So let's be clear, we have invested in the TPG Rise Fund because it raises, I think part of what we need to do is build the space, and having a player like TPG come in helps to improve the credibility of the space, prove to the world that there are investable, impactful opportunities there. However, one of the things I will say is that in our experience, we need a range of players. We need the big funds. By virtue of the size, they would only invest in a certain type of company or a certain growth scale. But a lot of the innovations that we see in impact also come from smaller funds. So what would be unfortunate is if the presence of these big ticket funds starts to starve other funds of capital. I think that would be a big disservice to what we really want, because if we take a step back, impact is really about providing solutions to problems that are underserved. And if we're focusing on a typical or a particular type of investment profile, we will not be really serving our objectives in terms of impact. So for us, while we would invest in the TPGs of this world, we also invest in a range of fund managers and a range of business models, from venture to first-time fund managers. What we're really looking for is this an effective solution for the challenge that we've identified?
Yeah, and I mean, the role as well, I think, historically, in terms of backing these funds, have really come from, I guess, public money in the forms of DFI or other cornerstone investors. I mean, a lot of institutional investors are looking at that. If a sector still needs a level of subsidy, then surely there's going to be question marks about the returns that I'm going to be getting. But, I mean, do you still see that as an essential part of, you know, the fund ecosystem, particularly at this early stage?
Yes. Taking a step back, our priorities in terms of how we invest, we are mainstream in the way we look at returns. So we're not investing in sub-market return opportunities. Let's be clear about that. But in order to bring some of these innovations in the market, looking at some of the challenges we face as investors, as institutional investors, in terms of the kind of returns we have to make for our clients, we need DFIs to be part of this process. Even sometimes it's about giving us the confidence in using blended capital structures to go into some of these innovative ideas. And some of the ones we've invested in, I can give examples if we're allowed, not promoting particular funds. We've invested in a fund, for example, that is really tackling the problem that diseases of the emerging world are underserved by big pharma. Now, we are mainstream investors, we invest in big pharma, but I know that when we have discussions with them, we really need R&D to bring a certain type of results, of returns. So there is a vacuum out there that needs to be filled. What blended capital did in that sense was to give us the confidence to invest. So there were kind of first loss structures that we invested in. But what is really exciting is that we're not going to need to access that first loss. So what DFIs and that kind of money can do is to work with us as institutions to help give us confidence, given our investment parameters, to go into some of the most innovative ideas. And if you have good fund managers, as we do, if you look at the scale of the challenge, sometimes scale in itself can help to mitigate some of the financial challenges that we have. What will happen is that if we've put that idea out there and invested in it, it gives confidence to prove that this is a good enough model to invest in. And the next time a fund like that needs money, we won't need that kind of blended structure. But I think that there is still a very important role for that kind of structure to play.
And Fred, I mean, I guess that spills over into when you're looking at investments and your role in the ecosystem, when, you know, government support programs providing investment for R&D, for instance, in these early stage companies. I mean, how do you see yourself fitting in alongside that?
Yeah, so we're very different because, of course, we're not a big 3 trillion or 3 billion fund. I think the sort of USP or the uniqueness of the model that we have is that once we invest, those investees come into Sky, and then we help them develop their business, and then we take them to market. We'll help them find their first customers and grow. So it's a very sort of different role in a way. It's an additional role to just funding. And I think for governments, we found that it's an interesting way into some of the networks we have that we could deploy with them. So we've just done a partnership with the UK government last week, just some match funding, but which is very interesting because basically it opens the ecosystem much more widely. It allows players that might not know us in the impact area to sort of access us. And then sometimes, as I've already seen since last week, there's opportunities now for us to also, we've only been at it for 8 months, but I can already see that we can start joint investing, maybe with some of the players described, and because we offer that ecosystem. So, you know, the difference with the fund basically is that we can do partnership with National Geographic or Imperial or others because we have a set of tools that basically are are quite complementary to traditional funds. So I think it's an interesting test for us and pilot to see whether or not the model that we're developing at the moment can then be applied in other areas than just plastic. I didn't answer your question as to why we went into plastics. I mean, I did, but in terms of investment itself as well, it's because the pipeline was very dry in terms of the investment in there. And then since we've been set up, I've seen 300, 400, 350, I think, over 8 months, which shows that if you do go into it, suddenly you can find it.
And I mean, I think from a fund perspective, just moving on to origination for, I guess, Beth in particular, I mean, obviously people are always scared about setting up an impact fund because you're limiting the criteria of the types of companies you can invest in, and investors might get nervous about how quickly you can deploy. But I mean, is that something you've seen since you've since you raised your fund and you started the investment process, or?
No, I think we've got a good sort of pipeline of companies. I think there's a lot of companies out there that are very impactful. Obviously, we are sort of 12 years old as a private equity house, so we have quite a big deal origination team that have been in place for a number of years. So they're very helpful in contacting companies and originating deals for us as well. And also, you know, the advisor base that we've got as well. We're headquartered in Manchester, but with offices in Birmingham and London. So lots of advisor bring deals to us. I think the deals that we've done to date have all been, apart from one actually, in a competitive process. So we've been up against traditional private equity funds when we've been in that process. And actually being an impact fund has been a real differentiator for us because if you're talking to a management team that are in an impactful business, they're really impressed that we can talk to them about developing the impact side of that business as well as the return side. And when you're up against more traditional private equity houses that are maybe not having those conversations with management teams, that has been a real differentiator for us. And so often they've chosen to work with us over and above other PE houses.
And Marjoleine, I mean, when it comes to funds on the origination side, I guess as a fund of funds pool, when you're looking at the option for fund, I mean, are you at a position where you're pushing funds away because you have to make a decision given the limited capacity you have?
Yeah.
I mean, how are you seeing the pipeline building for you over the last couple of years?
Yeah. So I think that we definitely first we see that lots of new initiatives come to the market. And we don't shy away from investing with first-time funds or first launches, and I think we have the added benefit that we can invest across all private market asset classes. So we invest in private equity, but also infrastructure and private debt, which helps massively. And then I think what also helps is that we have 20 fund researchers in our firm. And they all have their specific expertise, and they all look out for us to when they come across a fund they like, they will push that on to us. And it's funny that, and I think that's, I hope many of you share that view or that experience that as soon as someone comes into contact with impact, they are sort of drawn into it because they can use the skill that they normally have, like they can normally put to work, but then with the added benefit that you actually add something to the world. So we've had literally our lawyers are sourcing funds for us, our CEO. It's literally there's more funds coming at us than we can invest in.
Yeah. And the point of obviously you're branching out to different asset classes with the funds you're investing in. I mean, that issue I mentioned earlier of illiquidity. I mean, this is still quite a niche area, and a lot of mainstream investors simply I just don't have that risk appetite yet because of the illiquidity. And yes, there are some solutions, but is that something which can be overcome? I mean, given the current state of the market.
Yeah. So, and I don't want this to be a product push because I hate that people are on panels and then push their product. And I'd like to say that I'm very happy to. But so I'd like to say, like everyone, you can look at our blueprint and then take that and multiply it by all means, because what we're just looking to do is build bridges because we see there's lots of capital needed in the world to work towards the SDGs, but there's also lots of pension funds clients, and they all want to deploy capital, but they don't know how, and there's just not enough bridges. So I think the AXA funds, we like them, and then those are very good bridges, but also Palatine funds and what Sky is doing, they're all little bridges, and we've just built our own bridge, which caters to our pension funds and family offices' needs and they just want they want more liquidity rather than a fixed structure of 10 plus years. And it is possible. You just need to, be a bit clever about certain things.
Yes, sure. I mean, in terms of the term impact, I mean, we've for years struggled with different investor perceptions when we use the term impact. Some see it as a negative, some as pigeonholing you into a specific asset class. But I mean, I'm sure you've all had different conversations with limited partner investors or other competitors and parties you're dealing with. Of how do you bridge that gap of impact, particularly if you're suggesting you're going to be providing market rate returns as well? Do you not have that conflict discussion with investors that we often have so much? Maybe Sade, I would just open up to you on that one.
I think one of the useful things that has happened in recent years is the Sustainable Development Goals coming as a common framework to reference what we really mean by impact investing, which for us is very much focusing on solutions to underserved people or underserved problems. And with that common referencing and framework, it's made the discussion much easier for us. Everyone, like the Dutch pension funds, for example, and different groupings around the world are all really thinking consciously about what role they can play in meeting that SDG agenda. And that for us is a really good starting point in terms of having the discussion. So when we started in 2012, we really had to be very precise around what we meant by impact investing when talking to clients. But now they understand it, particularly using the language of the SDGs. So it's not so much a problem. What we find, on the other hand, is everyone now knows the language of impact. Everyone now knows about SDGs, and everyone now uses it as a framework. And what we now have to do is distinguish what is credible versus what is marketing. So that's where we are.
I mean, Fred, I'm intrigued as obviously...
Marketing's just been mentioned.
Well, marketing's been mentioned, so I can turn it straight to you. I mean, I can see the additional benefits other than the trying to solve the social issues for someone like Sky and many other corporates. I mean, have you seen corporates sort of looking at your model and saying, how do we do the same? I mean, obviously corporates are investing in impact funds, which are specific to their cause, and they feel they can add value, but you're taking that step further and actually investing yourself and actively managing that portfolio. So, I mean, are you approached all the time by... Definitely.
So I would echo what's been said previously in terms of the momentum that is created by just internally, just at Sky, just on the internal side, by the fact that we're now doing impact-driven projects, and the appetite for a lot of execs to sort of be involved with it, and also employees, and we're even looking at how we can get employees to participate in the decisions of investing, which is a bit complicated, but just more broadly, we have a lot of players that come and want to coalesce with us or want to be part of the fund. The very big difference is that we don't have LPs, we don't have GPs, because we still have an internal fund. We might get into that when we feel the model has been built and we have proven the case and we have built credibility. The thing about impact that I would mention is what's very interesting for us is that we have a really frontline experience of impact, because basically we take those investors at the very early stage and we really develop it with them, and we're really trying to get them to track for us in a very narrow way. We go material innovation, responsible consumption, and circular economy at the moment. And in every investment we make, we really want them to describe first the sort of direct impact they can have on what we've described as impact objectives. And then after, with that narrow focus, prove to us that it will have a disruptive change. Because we set ourselves up as a fund which wants to have or help system-level change. It's a very sort of much of a stance that we've taken. We don't want to be in impact if we're not helping disruptive change, because that's what we should do, because we're big and we can take that risk.
Do Sky have any, sorry to interrupt.
No.
Go.
Do Sky have any return expectations on the fund?
So we always say, thanks for this. No, because I should have mentioned. So we always go by decisions by impact first,
Right.
always, and I've probably you've maybe noticed we also want them to be commercially viable, and hopefully, but I shouldn't claim this, but we hope to make from 7 to 15%. We always do that.
Right.
But the decisions that are made at the IC are very much around impact first. For example, we have one we've just made where we will sort of pilot it across our customers to try to sort of give them a chance to scale and get adopted, and that's all because of impact. So because to try to sort of bridge it into the consumer space. But the way it's run, it's very much run with an idea of expectation of return. And all the return goes back into the fund.
Right, okay, cool.
It's an interesting point. I mean, track record for first-time funds particularly is always one of those real pinch points for mainstream investors. So, I mean, Marjoleine, you mentioned you don't mind going to the risk of a first-time fund, but what gives you that comfort that a management team, if they don't have a track record of working together, gets you over that hurdle? Is it the level of impact or the strategy you love? I mean, what is it?
Yeah. So for us, well, I think that is personal, but I think that so I have a lot of experience investing with first-time managers from my previous job. So it's, and I think you learn by doing as well. You learn where do you need to focus on. You need to go through a couple of mistakes, and then you learn from that. But I think also you set your own criteria, and you just stick to that. You really shouldn't adopt any other criteria. To me, we don't adopt any other criteria for impact funds than we do for our normal funds or say ESG type funds. We just add criteria, like we add intentionality. We add, do they measure, what level do they measure, what's the intention of management, intention of the business, is there any thought leadership? So that's what I would like to, if anything, if anyone wants to start making these investments, just list your criteria and then add what you find important from personally.
And not just to follow on that, I think one of the big conundrum we have is measurement. And so as probably many people who do impact, so we're embarking now on sort of a journey of trying to really get into the methodology of measurement. And that's why also within that ecosystem, we sort of try to partner with funds that have sustainable equity sort of fund experience and know about sort of measuring maybe more mature growth investments. But I think for the early stage investments we make, it's how do we map that out? What does that entail? It's quite difficult because it's very generic still. So
I'm gonna open up to the audience. So some questions. I think we've got around 20 minutes or so. I've got a few more, but does anyone want to kick us off with a question?
Hello, I'm Frederic Gaillet from Talos Impact. I just wanted to reflect on what you just said about the criteria for impact fund and not applying other criteria than usual. But I was wondering to what extent, at some point, if we want the fund managers to stick to his objective and keep impact, to what extent do you envisage applying some impact-based type of incentive and maybe changing a bit the carry structure to link some sort of financial reward to also impact objectives? Is that relevant at all? Do you think do the GP are willing to do that, and there's more maybe hesitation from the LP, or the other way around? What you're thinking about that, and maybe not only to you, but also maybe AXA, how they would see it, or other panelists? Thank you.
Shall I take that first and then you go?
Yeah.
Because what we've seen is that we've seen that increasingly become incorporated, but that it isn't the dominant factor, or predominantly it isn't the case still. But what we try to do, so whenever we are a first-time investor or we help launch a fund, then we try to have a conversation with the team and put that in. And obviously, if you're first-round investor, you don't. There's little chance that you can put that in. So that's the advantage of going in early. and we see it increasingly. And I think also the European Investment Bank, for example, I've seen them, they do that now as well. Their criteria are still quite light in the sense that they're being careful about it, and rightly so. But I think that increasingly you see other parties also doing that. So I think it's a motion you can't stop anymore. So in a few years' time, probably more and more funds will have that. But
yeah, it is something we see many funds adopt, but it's still not yet universal. And I always think sometimes we don't demand it. We support it if funds want to have it, but we don't demand it as of yet. Because if you look at the many impact objectives that are tied to carry right now, a lot of them are very soft. The main focus for us is really thinking about the objectives of the business, how it's going to be achieved, and also realizing that we're investing in real business models, particularly at the early stage, that would have to evolve. So if you put together impact criteria that would stop the business from evolving, we may actually be doing a disservice to our real objectives. So it's something I support in principle. We're still looking at it carefully. If a fund wants to have it, we don't object. But we really think that particularly with early stage models, you really have to be careful, because if you look at incentive structures from the public market space, we've seen how that in itself can overturn the objective of a business, because management starts focusing on meeting the narrow definition of remuneration in a way that may not serve the long-term interests of the business. So it's a model we're looking at carefully. A lot of them are very simple to achieve, and we're conscious about the fact that it should not stop early stage businesses from evolving. So that's where we are now.
Yeah, we don't. We haven't got any of our carry linked to our impact KPIs. I think it's actually very, very difficult to do and do it in a meaningful way. And I think you'd have to agree on each of your individual investments. And then, I know that some GPs have had a panel of LPs to sign them off, but it gets very, very complicated. We have given 10% of our carry to a foundation. So we've sort of done it that way. And then we also commit to our LPs to report on a quarterly basis on both financial returns, as you would expect, but also all our impact KPIs as well. So we develop 4 or 5 impact KPIs for each of our investments, and LPs will get feedback on how we're performing against those KPIs on a quarterly basis, and then a fuller report on an annual basis.
Yeah, hi, Vince Smith, Iceni Capital. I'd be interested to know how you manage the expectations of your investors and your various funds in terms of target returns. I mean, I understand, Beth, your full-on returns, not compromising your returns, but for Marjoleine and Sade, you're building a fund of funds with a number of GPs within that fund of funds, being presumably, as well as an overlay for geography and sector and stage and blah, 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 are you also looking at a blend of returns for the underlying funds that you're investing in? Because some will be, targeting full returns, some will be much lower on the return spectrum. And so that, or that is that not the case?
I think you answered the question. So the beauty of our model is that we can set a fund level target return, which allows us to do a mix of things. So there's some strategies, for example, if you're doing healthcare infrastructure in emerging market, the level of returns that we can expect from that is quite high. We can, in that same portfolio, because we have some liquidity requirements for some client, include some microfinance investments too, which are lower. We may be able to do some still market rate return, but maybe because of the geography, it's lower. We just do we're able to put together a blend of investments that helps us to still track our overarching returns objective for our clients. And that would also take account of different asset classes, PE versus debt, different returns expectations. So what we do in terms of discussing with our clients is setting that fund level return and helping them understand the different ways, the different asset classes, the different geographies we will invest in to achieve that.
Yeah. I would second that. Yeah, it depends on the asset class, but we target market rate returns because most of our clients, they're pension funds and they have a funding level to think about. So and most of them aren't in the position that they are that they can be a bit generous with their with giving up returns. So yeah, we target market rate, but it depends. If it's private equity in the emerging markets, we require a higher return, and if it's private debt, it'll be different. Infrastructure, it'll be lower, depending whether it's greenfield or more core.
So just quickly, as a follow-up, I mean, most of these funds are still relatively immature. I mean, I know that you set them up in 2013 or something. Where do you think the return expectations will be on target, or are you going to be managing expectations of your investors in due course as some of these things come to fruition? Because actually, it's great, the idea of impact and everything else. You've set your target returns. I mean, time will tell as to whether you're going to achieve those. It's
a fair question, but it will be like with any other investment, right? Some investments will yield you better return than expected, some at par, some lower, and its impact won't be any different, I think, yeah.
I agree with that, and let me touch wood right now, because we're tracking closely. So we now have like over 5 years, right, in terms of returns. And it is actually exceeding our expectations. And what's actually most exciting is some of those innovative models that we invested in. Because we're testing things like, can we provide, can we invest in R&D for neglected diseases in emerging markets? So that model has never been done. What do we do in terms of protecting natural capital? Really investing in real new innovations, and they are doing very well. What we found, for example, in that fund, we've had an IPO. We've been able to get priority vouchers from the FDA, for example. So this for us is real proof that you can really use an impact investing lens to fund innovation, whether you call innovations that are commercially viable. So this for us is looking at, we approach this from an impact investing perspective, but these are real commercial opportunities out there that you should look at anyway, whether or not you're coming from an impact investment perspective or not. And we hope that it continues to perform as it is doing now, but we're really positive on how the fund is performing. But of course, I'm not marketing anything. This is using all the usual caveats.
Hi, Yoshiko from DWS. I had a question about the liquidity, especially to Marjoleine, but also maybe people in the audience could also clarify this. I did hear about liquidity becoming a topic that investors, asset owners wanted to have when they look at assess funds. And obviously, from myself being an impact manager, fund manager in microfinance, when you have liquidity, and we've seen a case 5-6 years ago when $400 million of money just left in one go. And when the size of the fund is $600 million and $400 million lease, that's obviously not good for the underlying borrowers who are the microfinance institutions on lending to micro borrowers. So against these kind of purpose and objectives, what is the situation? Where are things now or evolving on this need for liquidity? Is it a regulatory thing? Is it something that we can reach some kind of a midpoint or compromise to kind of balance the demand and what the underlying situation is?
Yeah, I think it's a complicated one. So there's many dimensions to liquidity, because I agree with you. So from your perspective, running a liquid fund with microfinance with your lenders, so you have to take into consideration that if that money falls away, who else is going to lend to these? It's often repeat lenders, right? So that's also an impact you need to consider. But there's also, I think, as you rightly say, liquidity from a regulatory perspective. It's another dimension. Other investors just like to have that, or pension funds in the Netherlands, they need to have if it's less liquid, they need to hold an extra capital buffer, which costs them returns, so to say. So I think there's many dimensions, and it's hard to make a generic statement about it just now. It's just what we've done is we've built a waterfall structure in our funds, and because we have a blend of asset classes, so we don't invest in listed equity because I think that our investors don't need us to invest in a listed equity. They're probably very well off doing it themselves. But we help them build a portfolio in infrastructure and private debt and private equity. And with all of these, they have different maturities, and money comes out. Infrastructure pays annually. Private debt has a coupon. So there's ways to work around it from our perspective. But then you have a different perspective from a microfinance point of view.
So interesting to hear everybody in the audience also, maybe during the coffee break or right now. But this has been a point that's been pointed out a couple of times. If there's a cost for this kind of liquidity topic, how do we go about it? And we've tried to kind of reach a compromise by issuing different tenured notes, 3-year, 5-year, 7-year, so that different types of investors can come in. But it's a topic that is quite important for the industry.
Hi there, I'm Andrew Dykes, founder of the Global Sustainability Trust Initiative. Now, not wanting to pitch my product, but the question was asked, how do we work on a solution? I've been working on a solution for 3.5 years with a coalition around us, and actually it's using a vehicle that's been around for 151 years, the investment trust. So you're wanting to get into, many investors wanting to get into illiquid investments, but there is that liquidity, whether it's the retail investor or it's the pension fund from the sort of regulatory buffers. So that's something we're working on, so I'd love to speak to you about it, and anyone else who wants to find out more about how an investment trust structure, which has been around for 151 years, can be part of the solution of democratizing, mainstreaming and scaling impact investing. Because I think the democratizing is the big elephant in the room. We're all here, many of you representing people who can get into a private equity fund with a minimum ticket size of 5 billion, or you can be a customer of a wealth manager with 250,000, 500,000. But how do we allow the person, man and woman on the street, to invest in this? And there's many people want to. With an investment trust, you can do that with a minimum ticket size of £500.
Any other questions?
Hi, Jonathan Adams. I'm Vestec Asset Management and also one of the founding ClearlySo Social Angel members. So I had a question about kind of derivative question on impact measurement. I suppose probably targeted more Marjoleine and Sade in the sense that you have, in what you've invested in, a longer term track record of measuring impact. I'm not so much interested in how you measure impact, but more how confident you can feel when you talk to your investors that you have demonstrated creating impact over time in the funds that you invest in, and then when you're looking to invest in funds, if that's the relevant question, how you feel about other people measuring impact and how confident you can be in how that impact is measured. Thanks.
I'll take this one first. The most important thing we set when we invest in a fund is we set objectives around impact, and key performance indicators are required at the report. But one of the things that we've learned over time is what we're really investing in is the change, the effect of our investment on the ground, whether on people or environment. So it's not just about the theory of what is said, but what we actually see. We have to spend a lot of time in terms of monitoring our investments. It doesn't stop with just getting reports from our GPs, but we spend a lot of time traveling the world to see the effect of that investment in the real world. So, for example, you'll get reports saying an investment in, let's say, providing financial inclusion to farmers, it's really making a change. Only for us to get there, and maybe the farmers, yes, they're covered by the program, but they're facing real challenges, meaning the depth and effectiveness of impact that we want we're not getting it in the real world. We're getting it through reports. So those are the kind of things, those are the kind of assurances we provide our investors, that we're going beyond just looking at report, but part of our monitoring is really visiting those businesses that we've invested in, visiting the underlying beneficiaries and understanding whether the innovations and the business models that we've invested in are really creating the changes that we want. So that for us is the way that we've done it. We have our fund set objectives. As part of our due diligence into the funds, we go to where the businesses are cited to understand what the challenges are. We get reports back about the progression they're making, but we also, as part of our monitoring, do visit some of these underlying businesses to make sure that we're really making changes in the real world.
Yeah, so I think we do the same. So it's monitoring, it's so important, but it's with all of your investments, and impact investments aren't different than normal investments in that sense. And I think we also, I'm sure you do the same, we also help our investments pull together a theory of change. So we start with, okay, what is the problem you've identified? What is your solution to that problem, and how do you go about your ways, and what do you put into that? So it's that output, outcome, impact, and then sort of that's how we derive our KPIs for that specific investment. So you directly link your KPIs to the impact, and it makes it, rather than just pulling some KPIs out of thin air, because then it might probably make it more difficult to monitor that or to actually get data from that.
No, just quickly, just two things. We tend to do a lot of due diligence when we invest, and that helps us with the KPIs we set up in due diligence to actually track their impact. And those tools actually we're developing now, we're sharing with financial players because they're all about being very diligent and very detailed on how we focusing on it. The second thing I was going to mention, I've noticed over the last few months a discussion among corporations like us, but also financial players, banks, trying to sort of devise what we could set up as a sort of index of real measurement for corporations to use vis-a-vis their investors, their shareholders, on the impact side. And I think there's an appetite for us. For example, we did it when we went carbon neutral, and we had some tools and some ways of measuring it. I think there's an interesting challenge now, even globally, to sort of set up something which companies could use in order to take that message of impact also to their own investors and shareholders, and to have something that really is an index to measure. So just to say, we're going to try to do that.
Time for one more question.
It's actually a related question to that previous question. Do you find that costs related to, for example, extra research that is impact related, ESG related, and many extra monitoring costs are significant, or are they not that much different to possibly a normal investment?
Yes, so for us, we don't put, so we try to identify the KPIs that you can get that are meaningful and you can achieve easily within a short time frame and at low costs. But that's us.
Yeah, we have to be clear. The reason we're investing for impact is for change. And if after 10 years some of those changes that we're looking for have not happened, we have failed. So it is part of the responsibility we bear to our investors to make sure that we're not just achieving impact in theory, but we're achieving impact in practice. So we use all of the processes described, theory of change leading to objectives, leading to key performance indicators. But I know the motivations of my investors. So if, for example, we're investing in early education in Africa, which we do, if it's not enough to just put in the business model, the real impact that we're seeking is that the life chances and the outcomes that those students get from education is better than if we had not intervened. And our monitoring is very closely linked to that. We're based in London. We've given capital to fund managers all across the world, investing in innovations all across the world. It is part of what our investors expect, that we monitor those investments closely, so that at the end of our 10+1+1, we know where we've made credible change. So,
thank you. So are those investors then more likely to tolerate a small decrease in performance to account for increased monitoring or other ESG-related costs?
Let me use a parallel example. We also have a fund-of-fund business investing in mainstream, alternative investments, and they do as much monitoring as we do in the impact business. In fact, the people doing the financial modeling for us, they're the same people in our fund-of-fund team. This is the model we use, where there's a lot of monitoring visits, a part of our mainstream investment strategy for this type of business. So we never go to our clients and say, because we're doing impact or we're doing ESG, you should expect lower returns. It's part of the total cost of us doing business that is no different from our fund-of-fund business, where they visit and monitor quite closely. That's the nature of the business.
Thank you very much.
Great. Thanks very much for the questions. We're going to take a short break now and have to wrap this up, but I'm sure the panelists and everyone else will be able to answer any more questions in the coffee break. We're going to take a 30-minute break outside for some refreshments, and we're going to be back in here at 4:15 for our fun presentations. But if you could all join me in thanking our panelists for a really interesting conversation.